The next session is really more about us digging a little deeper on custody and how custody is powering liquidity and institutional trading. So I'm going to keep it very short, and I'm going to very quickly call Rob Benke to kick this conversation off, because I do realize we are between lunch and a very engaging conversation. Thank you.
Test, test. Hey, everybody. Good morning. Good afternoon. Yeah, good afternoon, everybody. Panel, thank you for joining. I figured we'd just have a conversation today. Keep the questions nice and spicy, maybe go from there. So my name is Rob Benke. I am the co-founder over at Halborn. At Halborn, we are the security advisors to some of the largest blockchain initiatives going on around the globe. We're here to focus on things like ethical hacking, pen testing, and then of course advisory. So helping folks really enable tokenization and custody and things like that. Panel, thank you for joining me. Got my intro out of the way. So I'd love to just ask you all a quick 30 seconds about yourself, what you're up to in the space. So kick it off with Lior.
Yeah, hi everyone. Great to be here and good to go into this topic today. Lior Groen, I'm a managing director at Spartan Group. Spartan Group is one of the first institutional asset managers in the digital asset space out of Asia. We have our offices in Singapore and Hong Kong. We run an asset management business and investment banking business, fully committed to this industry. So we run a liquid hedge fund, multiple venture funds, an active M&A advisor and deal maker in the industry. So look forward to going deeper into custody with you all here.
Hello, everyone. Thank you for having us, and my name is Chris Egan. I'm from JP Morgan in our Security Services division, looking after digital assets for institutional clients. Don't wear quite as many hats as all that, so we'll just speak to some of the custody and fund admin work that we do.
Good afternoon. My name is Vic Call. I'm from Silence Laboratories, where I head products and partnerships. Our company is in the business of providing technology to enterprises for them to roll out their own custodian solution.
Hi everyone, I'm Grace Chow. I'm with Citi's Markets Digital Assets team. We focus on sales and trading applications of digital asset technology. Citi as a whole has been actively working on a lot of initiatives in the digital asset space across all of our business lines. One of them, to say the least, is the development of our foundational digital asset platform called CDAP. And very recently, we also announced a partnership with SPX on tokenized pre-IPO stock. So happy to get into that and other things in the next half hour.
Incredible. Well, let's keep it simple here. So just to get things started, what have you all seen as probably one of the more important, or let's call it the most important change that you've seen custody sort of be able to affect liquidity? So, as we keep on thinking about this, in the last 12 months, for example, what do you think has been the most important change? Maybe we can start with you, Grace.
Yeah, well, Mike just mentioned this a few minutes ago, but I would go with SAB 121, because that, takes away a major hurdle for banks to offer custody on digital assets.
For my part, I'd say the accelerated adoption of stablecoins has just been tremendous. I'd say that for the past few years, a lot of the conversation has been around how does the cash leg of all these blockchain trades work from, we'll call it the more institutional and traditional side of the house. I've definitely seen a lot of use cases that were using wires on the back end and not having a true versus payment solution. For JP Morgan's part, we have developed our own, we'll call it cash on blockchain solution. But what's been very notable is that the stablecoins in a public blockchain context have gained increasing adoption and confidence that I maybe wouldn't have predicted 12 months previous.
I think what I would add is that as folks have matured in the industry and their understanding of custody, that to think of it simply as a vault, which is what they historically thought of, right? To think of more as something that they can program, trust around, and the moment they can do that, then that just opens up many more avenues for what they can get done on chain and what they feel comfortable doing from a risk and compliance point of view as well. Yeah.
Makes sense. I'd like to dig a little bit further into that. So, in the world of custody, obviously we're looking at this as unlocking liquidity and institutional liquidity. How do you think about, and how does the companies that you work for think about the differences between, for example, like hot and cold wallets? Because obviously, you have your hot wallets with the ability for sort of sub-second settlement, which is like the true innovation, one of the true innovations, right? But then you have, the cold wallets, obviously, they're going to be set up differently. So how are your, different teams thinking about this?
Sure, yeah. So in our case at Silence, as I said, we are a technology provider. We have an MPC-based solution. Yeah. We can coexist and work with HSM solutions as well. Right. And I think over time, I expect more of the institutions feeling more comfortable getting more of the transactions done on a hot wallet or using MPC-like technology than continuing to insist on HSM. But as we talk to customers today, we often run into institutions that just feel more comfortable with HSM because that's what they've done historically, that's what risk and compliance feels more comfortable with. And there's also this idea of they would prefer to have layered security where they don't want to use the same technology across the board. So they prefer keeping some things on the cold side, some on the warm. Obviously, that comes at the expense of how fast they can react to things, keeping a tighter control on stock and flow. So depending on how paranoid they're about that versus security is how they make that choice on the curve. Yeah.
Yeah, maybe I'll take a bit of a departure here. For our part, JP Morgan has developed what we call the digital debt service, so a permission blockchain application where the speed of a hot wallet isn't really the critical factor. We're still dealing in settlement days as opposed to T-instant or trying to get settlement as close to near real time as possible. So looking at the same sort of settlement timeframes that we would see in the traditional world, trying to keep that consistent with how the blockchain operations are working through that application. So the difference of how these keys are being held doesn't really come into the as play as dramatically. I think that for better or worse, when we're still talking about USD as our settlement mechanism, we're still tied to traditional deadlines at the Fed as some of the defining of our days and not quite operating in that 24/7 timeframe just yet.
And I would say, just like in general, in terms of the design choices around the different custody technology, whether it's hot wallet or cold wallet or warm wallet, what kind of signature scheme is it? Is it single signature, multi-sig, MPC, HSM, or no? All this really has to depend on your use case. And so if it was trading, then maybe you make that trade-off between better speed than maybe single signature, right? So you have to look at it on a case-by-case basis.
Yeah. Makes total sense.
Yeah.
So, given exactly what you were saying here, Grace, where it really just depends on the use case. So let's take a use case. So, stable coins, tokenized deposits. Where does the custodian now sit? Whether it's, when you have a workflow that doesn't sleep now, like, what is the custodian's responsibility and where does it sit now to help unlock these things?
I mean, I could take that up.
Yeah, please.
I think that, and this is a little bit forward-looking, not exactly where we are now, just because, right, I'm talking about a use case that's permission blockchain using USD in traditional bank accounts, but ultimately can communicate via our own Connexus digital asset network. So we're playing with our own, we'll call it house money, if you will, of JP Morgan's own balances and not dealing directly with those public blockchain stablecoins. But I do see that there is, just as today, where a custodian is helping institutional investors with the FX that they have between their various markets of investment and expected to be that intermediary between the fund or the end investor and the market. I think that there's going to be a call for custodians to act in that same capacity when it comes to blockchain assets. So being an intermediary to have an on and off ramp between fiat and stablecoins or fiat and CBDCs, what have you, whatever that cash on blockchain solution does end up looking like, and whatever the mode is needed for the given use case or market, I'd expect that to be the going expectation that end investors will have of their custodians.
I think it also depends on what the appetite is for what they want to get done, right? So we do run into customers where they increasingly want the custodians to do more than just secure the asset, where they want to have the custodian participate in repo or doing some on-chain collateral, so making the asset more liquid so it's available for them to do more things with rather than just storing it.
Okay.
Yeah, I'll just add to this. Haven't said anything yet, so two cents of wisdom here. I think the distinction and what the role of the custodian, I think that's what's fundamentally changed with digital assets. I mean, the role that you're playing in that tech stack and the infrastructure and the service provision to anyone who is depositing money at an institution for whatever reason, wherever that's being held and underlaid. The fundamental opportunity set that we're excited about within digital assets is the decoupling of where and why am I putting money at a certain place, be it individual businesses for treasury management purposes or financial institutions for part of their process of actually managing and allocating assets, to what are we doing with them. And I think that decoupling of I'm a deposit-taking institution, the kind of qualified custodian legacy thinking of what has built the financial fabric and infrastructure of the world's markets today, and what's happening in the digital asset industry through, I think, as we mentioned, the initial use case of stablecoin that's pushing a lot of assets on-chain and into the public domain, public ledgers, the ability to then do things on the back of this. And I think where the asset lives and how it lives is what's exciting about this space. And it all comes down to ultimately having that composability of liquidity. So having an asset that can live on-chain, be it in the private permission system or public on-chain, the interaction between them will increasingly become relevant and important. And you know, large financial institutions are obviously taking their path of bringing things onto private blockchains. At some point, they should be interoperable, and what's happening on ultimately what the biggest liquidity venue today is, which is open public blockchains, and following that volume. So and trading flow, and that's the whole reason why this industry makes sense, and everyone's going to have their own roles and gatekeepers and functionality of how they engage with it. But ultimately, we are creating a globalized pool of liquidity, which is a hybrid of on and off chain requirements, and the role of the custody as that initial gatekeeper has fundamentally changed in the on-chain world.
So how do you feel that like institutional grade custodians, they're obviously rewiring the way that large investors sort of, you know, source and deploy liquidity, right? So how are we seeing that play out right now within all of your, you know, individual institutions, but then also your, you know, just the experiences that you're hearing there? So obviously you have, you know, OTC desks, you have these sort of, you know, liquidity pools, you have new trading lines. So how are you thinking about this?
I'll take it from my perspective. Obviously, then we'll let people on at the institutions talk from their lens. But I just take a step back in how we view this. And living in Switzerland, we had two of the early digital asset banks that got full FINMA regulated banking licenses effectively to provide services and act as a trusted bank, as you would expect from a Swiss bank. Now, what does their business comprise of? Being able to provide digital asset services, increasingly moving into tokenization of real-world assets, stocks, and everything that comes with that today. But this is still very much at the beginning of what they're trying to do and what their business comprises of today. And I think that we're still very early in the adoption of that, because today still the basic use case is providing infrastructure, you know, secure institutional grade infrastructure for people demanding digital assets. So either your crypto assets or stable coins and payments, and that's still provision. So all of the trading desks, where are the volumes and where is that happening today, I think is a very different KPI and metric than what a lot of the large institutions, especially here in the US, will be actually focusing on and building on. So I think that there's a very big distinction where the market is today, but that's effectively the opportunity, because we're just getting started with what happens beyond the speculative nature of the industry and what is the underlying enabler of real volumes that are still yet to come into either private permissioned or public open blockchains.
Yeah, I would agree with that. I think, we hear of clients who are saying, our custodian options right now, there's a lot of them that we like. They have institutional grade tech, but their balance sheets aren't very large. So we do need,
Still can't trade
larger,
with them.
yeah, we need larger custodians. So that is still to come.
Makes sense.
One change that we're seeing also is that with the crypto getting more broadly adopted, as people bring on real-world assets and they custody those assets, that's going to change some of the requirements that companies have around how they value the asset while it's being held in custody, how they use it for liquidity. So at Silence, we have the ability to integrate crypto virtual machine to the custodian data plane, control plane as well, which allows us to capture value of the assets on a much more frequent basis, or as frequent as the institution wants, from multiple external parties, perform some calculation against that and make that available to the institution that they can then value the custodied asset in real time.
Got it. Yeah, it makes a lot of sense. And as we continue to think on this with, everyone is talking about either you're putting these things on a permission chain, or there's all this liquidity on the public chains. What are you observing as sort of like the key differences in how your strategies are affected on the private versus the public chain side of the world? And how can custody bridges sort of keep liquidity from fragmenting between these two?
I think that's the million-dollar question, of course, right? I'll speak to the permission side. The uplift that we're looking at, it depends how you measure it, right? So the digital debt service application I was speaking to is for private placement security, which, as we all know, is illiquid and painful and often manual when we're talking about a physical certificate that needs to be sent by courier. So putting that and tokenizing that on blockchain gives you a level of versus payment settlement that you wouldn't get traditionally. You have a lot speedier re-registration and recognition of the new ownership. But at the end of the day, we're talking about what is ultimately a walled garden, if you will, of known players, permissioned actors, folks that have to onboard and go through KYC with any institution that's connecting into the network. So it's a small and a thin pool of liquidity that you would get from there. I think the challenge that I think we're sort of poking around at is there needs to be some sort of bridge between the two, a player willing to stand in to broadly tokenize assets on the private side and represent them on the public blockchain side. I think that at least from our seat, it's not an insurmountable challenge, but it's a different degree of risk that comes with that intermediary role when thinking from the custodial perspective. A lot easier to work through any problem or issue that could crop up when it's a permission chain and all actors are known versus the risks that you would have when trying to manage your keys and transactions and counterparties when you can have all sets of bad actors or technological disruptions that you don't have that same sort of recall or resort to the authority of the known parties. So.
Yeah, I think the key there is to provide better interoperability, whether it's just within the public chains or between private public, which will require better standards to be established across the blockchains around key management, key signing, and other parts. So that's the folks like Chainlink who are actively working on that. But until that gets solved better, it will we'll continue to have the issue of having islands of liquidity that isn't easy to move around.
Yeah, I mean, are we destined for this for the foreseeable future, where you just have this hybrid model? Is that kind of where we're at right now?
I mean, speaking from my own perspective, I'd say that I'd fully expect us to be in a hybrid environment for quite a bit of time. The traditional financial markets aren't going to go the way of the dinosaur anytime soon, from what I can tell. And we're going to have pockets of these permissioned blockchains which hopefully over time will have the interoperability they need to be able to connect into public blockchain use cases. But I do think that there is probably still a case where permission blockchain use cases can continue to exist on their own small pockets and islands, and there can be bridges here and there, but I'd expect it to be a sort of a mark or a feather in your cap as a service provider, the more of these permission blockchains that you can connect into, as opposed to there being a layer zero industry solution in the near term.
Yeah.
I just echo that. I mean, in a sense, on one hand, obviously the financial institutions are not going away overnight, but I do think in what we look into the market, a lot of what's happening on-chain in the public domain is kind of a test case, and it's proof of concept, it's a sandbox. That's the way most regulators around the world have looked at and viewed approaching the industry and supporting entrepreneurs in their local markets to be able to do things. So a sandbox regulatory environment for entrepreneurs and businesses. And I think that that's been successful to get to where we are today, which if you look at the evolution of the industry is actually quite impressive to have, again, the number of stable coins issued and at the volumes in which they're being transacted, which are competing with the likes of anything that even a PayPal has been able to offer on terms of volume and size and distribution. It's impressive of what's happened on-chain, and I think the beauty of where we sit here, I mean, looking at that and contextualizing that to a private and permission network, which again, here in New York, in the US, you have obviously the largest financial institutions in the world, being able to replicate that, taking the best practices of what's happening in the permissionless environment, understanding how pools and the composability of liquidity looks on-chain, and people being able to move from yield-bearing assets, from stable coins to real-world assets and everything in between, to be able to having pooled environments on interest-bearing products within a permission network for your customers eventually at a large Wall Street institution. We're a long way away from doing that, but certainly the playbook and everything is being tested on-chain. And the reason that's important is today, I think some of the biggest success use cases within the custody aspect are projects and ecosystems like Gnosis, which was built for the Ethereum Foundation. They've actually, secured over 100 billion in custody in their safe wallets. I mean, these people are effectively larger than most small European banks at this point, right? So the scale topic is already crossed that inflection point. The technology is there, managing, hundreds of billions in on-chain solutions. And now, how does that actually work within the traditional financial infrastructure? There's a lot of best practices of what you can do there, but I think we're just at the tip of that iceberg, basically.
Yeah, and I'll just pile on and agree as well that for the foreseeable future, there will be hybrid on and off chain. And I'll just mention some of the FMI initiatives, just to give examples. So the Euroclear DFMI program, which the city was a part of, what it does is it issues a digitally native note. So the issuance is on chain, but immediately after that, it gets immobilized and flips back to the legacy infrastructure for secondary trading. Right, so there's always that combination. Similar with SDX, anything issued on that exchange is also tradable on the traditional exchange. And then you guys, most of you probably also watched a demo by DTCC yesterday where they talked about the very important functionality of conversion order. So again, creating that digital twin from a legacy ledger. So it will be hybrid.
For sure. And there's definitely, I just heard a lot of innovation there too, right? And it's just nonstop innovation. So what role do we think custodians are going to play to be able to, make sort of this idea of even collateral mobility? What's their role? What's the custodian's role there to make it more mainstream?
Yeah, I think that's a pretty good example. We've played in that space some with the tokenized collateral network. So that's, again, permission blockchain use case. But the idea there was to tokenize money market funds and allow that to be deployed as a means of posting collateral between parties. And as you can see, that's definitely a topic that's being taken up in the industry with consideration from the various commodities exchanges for those sorts of practices for tokenized money market funds. So I think that there's a couple of different angles there. One is that sort of bridge between your traditional financial infrastructure and the blockchain to be that trusted party that's attesting to and validating that the asset in question has been effectively immobilized. And there's definitely room to play there from a collateral perspective. The other piece too is as it relates to the underlying tokenization of the fund itself. So that being part of the, we'll call it the more fund admin or fund accounting side of the house. So a couple of different pieces between either taking assets that are existing today and tokenizing them based on the client's direction, or tokenizing the underlying asset itself and having that be the native instrument where you can use it to post as collateral.
Incredible. All right, let's. I have a question, and it'll be interesting to see if it's a little provocative. So 5 years out, which is the KPI which will ultimately crown a digital custodian and like sort of crown them king, right? So we have a lot. Of course, it's coming from everywhere, right? So assets under custody, integrity, breadth, like settlement latency. Is it something else entirely? Like, what is the KPI that we're really measuring to be the king or queen?
I'll say assets under custody. I mean,
Sure.
whoever builds the biggest network is going to create the most value for everyone.
Right.
So,
Yeah. It's not speed. It's not anything else. It's just the actual
it's a network
amount.
business.
Yeah.
Yeah, I think just along that line, I think it's the interoperability to solve that, to provide for a single key across
Right.
the multiple blockchains,
Right.
single key control.
Yeah, I definitely am in favor of the traditional assets under custody measurement, but I think there's definitely a point to say that the measure of the custodian is going to be just how many different networks you're connected into and how seamlessly a client can experience and move between those. I'd say that for the end client's experience, as long as you're actually fulfilling the needs of the transaction, I think that there's not going to be as much attention focused on just how and why or the means by which you're connecting into those various networks, as long as you're doing a successful job of it. The only thing I challenge is that I think 5 years, sorry to steal your thunder, but 5 years maybe isn't the right sort of time frame here. The true mark of the custodian is going to be measured in the course of decades as to how safely you can keep that assets under custody, how long's your track record. Custodians rely upon being able to point to a long history today of keeping traditional assets safe, and we'll all be starting from near zero again to rebuild that reputation in a new space.
Yeah, I actually want to take a slightly different approach on the answer. We'll all agree that having the assets, because they live on a chain somewhere, either private or public, is what matters. But I think understanding why this is important is the key point. So the whole point of having assets on a blockchain, right, is this is a technological upgrade on the financial fabric of the entire system. And today, I mean, if we look at where assets live, I mean, you have a whole suite of ECM, DCM products, FX, real estate, any type of asset, all living in each country in its own way, in a different system and a different method of accounting for, regulatory standards of, and ways of interacting with a form of understanding what that asset is. Now, the whole point of the digital asset network and industry, I think, is to actually bring this into not a single database, public blockchain. Like, that was a vision, I think, for a lot of the Ethereum founders and the kind of people in that community. But the basic concept is it's all living on chain somewhere, and the ability to interact between them should be seamless and composable. And the significance of that step is what's key, because if you have a version of NASDAQ, as well as all the assets at the financial institutions, as well as going to every exchange in Europe, LSEG, Hong Kong exchange, everyone's actually operating on a version of a system that can actually interact with one another seamlessly. That's when you've reached a point of I would say, success for the industry. And the only actual question is, where do the assets sit behind that is the custody topic. And I think, Wall Street banks here understand that that's where the industry could go. Still probably not convinced that it's definitely going that way. But if that is where the industry is going and all assets are living on chain, who is securing them, who's storing them? The best placed people to do that are the largest institutions today controlling those money flows. And I think that is in itself $1 billion opportunity. It'll take more than 5 years, but it won't take longer, as long as a lot of people think as well, for everything to be living on chain and seamlessly interoperable. Private, public, doesn't matter at the end of the day. It's living on a version of a system that everyone can see and interact with.
Makes sense. So I do want to compliment this panel. We've gotten almost through this entire panel without talking about regulation. So this is a real win for a digital asset panel. So I want to end, I know that we're just about to wrap up here. I do want to end with just talking about, in the future, what do we think right now is the sort of biggest obstacle to preventing custody from fully powering institutional liquidity? Like, what's the one big obstacle? And if you say regulation, you have to take a shot. Yeah, but yeah.
Well, it's definitely not regulation.
Yeah.
Yeah. We're seeing lots of positive signs there.
Correct.
But I don't really see any there's a lot of work to be done.
Yeah.
And still a lot of kind of education and choice and just working through things. But I don't see any major showstoppers or obstacles.
Okay.
Yeah.
Yeah, I would echo that point as well.
Yeah.
I think that a lot of the pieces have fallen into place. I think from my perspective, the institutional adoption on public chain has been a real tailwind as well to motivate custodians to do the hard work. I think that the solutions are out there, and it's just a question of the dedication of the resources, time, and prioritization to get it done in a timely fashion.
Yeah.
I would see it as there's still a very big part of the industry in digital assets who are just still asking the question of why why do I even need to put it on chain? And I think that's still the biggest barrier we face. It's the how we do it is increasingly solvable based on the level of technology and the regulation, at least in this jurisdiction now being at least more open to it. So it's still, the question is why, and I think that that's something that as more things happen in the sandbox and on-chain and people see the public permissionless side of things scale, that'll make more use cases clear and that value proposition so apparent to everyone that you're at a disadvantage to not have your US dollars earning a yield in a tokenized kind of stablecoin product or money market fund.
I think on that point, I think where we see the biggest gap is real world assets, where people struggle with the why. Yeah.
Interesting. Consensus
Outside of just the treasuries and the stablecoin. I mean, those are well known use cases, but beyond that, I think it's still a struggle.
Makes a lot of sense. I want to thank everybody for joining and listening to the panel today. Thank you, panel. And on to the next one. Cheers.